History is in the making. The S&P 500 equal weight finally hit a new all-time closing high. And for all the talk about thin leadership, mega caps, and participation, 2 years later, we finally did it. We broke the narrative, and it's not just a mega cap trade anymore. It's an everything trade. So are we about to enter reflation? Today, we're going to discuss that and what normally comes next. We're also going to be talking about Bitcoin, gold, earnings, as well as buybacks. 30% of market returns in the last 10 years are driven by corporate buybacks, and it's something we need to discuss. But with all the talk of all-time highs, pullbacks, rallies, what really matters is your portfolio. So today I'm going to be showing you one of my portfolios. I gave both these portfolios to you guys at the start of the year on the 1st of January, and the alpha I've generated might actually surprise you. So we've got a lot to talk about. Let's roll the tape. Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. So if you like this video, please subscribe, hit that notification bell. Let's get into it. Another green day, guys, led by tech, semiconductors, not so much application software, and Apple didn't perform, but the mega caps were on show. I'm talking Nvidia, semis, Microsoft, look at Adobe, Amazon, Tesla, Meta, Google, even like Netflix, these smaller names that were in like the FANG index performing really, really well. What did take it on the chin today was financials, and that's because Jerome Powell came out and said there will be bank failures.
There will be bank failures.
Crazy when you think about that. But we're probably going to see material weakness in consumer defensives. We're going to talk about why. We also got some earnings after the bell, Broadcom, Costco. We're going to talk about that. But a green day across the board. I mean, energy, utilities participated, industrials, this section right here, extremely green. I mean, the only place that beat it was semiconductors right here. Other than that, a very green day. And looking at sectors, guys, semiconductors, metals, comm services, technologies, it was risk on sectors that were really up there today, that really performed the best. Look at software, and then we had like GDX as well, metals, gold pushing to all-time highs, and every sector gained except XLF right here. I mean, even regional banks gained for the most part, but yeah, it was very risk on today. We're at all-time highs. And Tuesday's dip, I said people weren't getting defensive. It was just a liquidation. What you really want to see, like when you see those dip days, right? You want to see gamma move down the tape, right? You want to see a lot of negative gamma coming into the tape. And you also want to see rotation. You want to see rotation from the losers into defensive sectors. When you don't get that, guys, what you normally just get is a liquidation. And normally the next day or the next week, in a normal market, it'll be like the next week you'll rebound. In this bull market, you rebound the next day. But let's actually hop on the charts, the S&P 500, and have a look at everything. Now, looking at the charts, the S&P 500. Now, let's actually have a look at the indices. S&P 500 up 1%. NASDAQ 100 up 1.5%. RSP 0.78%, but up 0.39% in after hours. So let's call it 1%, right? Then we have mid caps, small caps, IWM up 0.8, 0.3, 0.95%, a little bit in after hours as well. And we could see here that bonds didn't really do anything significant, neither did Bitcoin, gold, or oil. The RSP, this is the weekly chart right here, all-time high close, as you can see right there, an all-time high close, absolutely crazy. We didn't quite close at all-time highs yesterday. We did today. Diving into the actual market cap weighted, this is the daily chart right here, guys. And you could see a couple of things. Yesterday, I mentioned great buying position was right there. If that broke, the next position was at this level. I said this on my weekend video. You guys can go and check it out, simply because that's where a lot of buyers came in last week. They found value. That's exactly where we found value yesterday. We did have a bit of indecision in yesterday's trade, but after Jerome Powell's comments, after some of the data we got in Europe and stuff like that, the market just absolutely rallied. Now we could see here that this is a green candle. We did get a bit of selling towards the end of the day, but we actually closed in the upper third of the candle, and that's very, very bullish, and also closing at all-time highs. And looking at this trend, guys, we got a low here, higher low, or equal low, at the same time, making highs all the way. This just looks really, really strong, even just on a daily chart. And I know the daily chart is where we can see a lot of like fluctuations, but we're just not really seeing that. I mean, we're really, hitting like equal lows at the same time. And if the daily chart is looking really strong, that also makes the weekly chart just look incredibly strong, and it is at the moment. What can we look at for the rest of the week? I think we just look at 5,200, because that's where the call gamma resistance is right now. And it's 50 points away. That's 1%, or just under 1%. We could definitely go hit that tomorrow, but I would really look at 5,200 more than I would 5,100. Maybe a little bit of a pullback in early trade, and then rally into the weekend and then a bit of risk off. So that's what the day's trade is probably going to look like tomorrow. However, let's actually go ahead, look at the 5-minute chart. So you can see here, we gapped up and pretty much rallied all the way. We did get a bit of selling at the high of the day, but inconsequential really, because, you know, bulls did come back in here. So what I would really look at tomorrow is probably this level right here. If we pull back to 51.50 tomorrow, you know, maybe we rise in after hours overnight, pull back to this level, and then look for dip buying opportunities there, go all the way up. If we do break this level, we can then probably look lower. But yeah, I would look at this 50.50 level. I would even move it lower. I would say right there, you know, because it'll coincide with some of these lows right here, these lows right here, these lows right here. But I wouldn't look at taking any shorts. We could, if we do find weakness, we probably do go lower, but I wouldn't take any shorts. I would really just only take longs in this market, especially when we're doing stuff like this, right? Like we're gapping up, rallying. You see that in a week, you don't really want to fight this trend. But all in all, guys, very positive day. The fact that the RSP made all-time highs is absolutely crazy. Closing highs, that's exactly what you want to see. It's not just a mega cap rally, it's a broad-based rally. Now, why did we rally today? Very, very simple. You know, Jerome Powell had his testimony, and he pretty much said the main thing. Now, these are not my quotes. This is from CNBC, Barron's, and Yahoo Finance. Jerome Powell said these. He said that rate cuts can and will begin this year in 2024. And that really sent equities rallying. Also, investor optimism was boosted after the European Central Bank lowered forecasts for annual inflation and growth on Thursday. They kept the rate cuts on hold as well. Really good thing. The market liked that. And all of this just added to the confidence that rate cuts are coming. And that's why equities rallied. You know, it was a macro driven rally today. It was rate cut hopes and disinflation. That's what really, you know, sparked the rally in tech and semiconductors and for the market as a whole today. Now, let's look at earnings, guys. So we had a couple of big names. We had Broadcom, AVGO, big name in the semiconductor, I think like the 10th biggest stock in the US. And then we had like Costco Wholesale. So let's actually have a look at each of these. Broadcom beat EPS and beat sales, but their guidance was just a bit weak. The market didn't really like that. Something we have spoken about is that corporates have actually been sandbagging guidance because the actual conference calls have been really, really good. And we saw this with PayPal. We saw this with Snow and a bunch of other names as well. And then Costco missed on revenue, beat on EPS. They were down 5.1% in after hour trade. So by the way, Costco trades at 53x, guys. Absolutely unreal that the stock can actually miss revenue and be only down 5%. You know, this should be down like heavy for stock trading at 53 times. But all in all, I think the market should brush off Broadcom situation. I'm not sure about Costco though. It would really depend on guidance and what the market expects looking forward.
Now we got the latest II sentiment survey. Now comment down below if you're bullish, neutral, or bearish, guys. However, the bulls are back in full force, 51.7%. I think this might be the second highest in the last 12 months, only eclipsing the 20th of December number here at 52.9%. Bears did tick up a tad, inconsequential though, and neutral down back to 26.5. Bullish sentiment is in the house, and last time we actually did get bullish sentiment right here. We're sort of towards the end of December, and you guys know what happened towards the end of December, start of January. We had that drawdown. It was about 4.5% in the Qs in the S&P 500. When bullish sentiment does get to these levels, we can actually see a little bit of a pullback. Nonetheless, you can see that in a bull market, bullish sentiment increasing, that just means higher price action in the future, and all pullbacks should just be looked at as dip buying opportunities. Now, guys, let's talk about Bitcoin. It has been on quite the rally in the last couple of months, and you can see right here, the reason being is number one, Bitcoin ETFs. But what a lot of people don't know is Bitcoin's halving. And essentially, Bitcoin's halving has a lot to do with supply issues. Long story short, what a halving does, it halves the amount of Bitcoin that miners make, essentially reducing the supply. And that's why we've seen after every halving 1, 2, and 3, we've had spectacular rallies ever since. And it's like there's a tiny bit of a consolidation period right here after the halving right here. And then we go on spectacular rallies, upwards of 80x, 2x, 5x, 365 days after the halving. The rally we're seeing in Bitcoin is leading up to the halving here in April. Also has to do with Bitcoin ETFs and supply there. I still don't think there's enough Bitcoin going around. And to be honest, there's going to be less after April 2024. Now, let's actually talk about gold. Normally when the Fed pauses and then cuts, gold goes on amazing rallies. Here, 2000 to 2005, 66%. Same thing here in 08, 189% rally in gold. Pause and then cut. Same thing here
here in 2020, a 50% rally in gold, and we probably are starting to see the early signs of this. Gold actually normally goes ahead, breaks all-time highs, and then keeps rallying, and that's probably what we're going to see. We're in the pause situation right now. Once the Fed does cut rates, we heard Jerome Powell saying it's coming this year most likely, we're going to get an amazing rally in gold. We could see 2,500, 2,600 in gold for 2024, something like that. Something I do want to note, when we see speculative assets like Bitcoin, NFTs, JPEGs rally, we see gold rally, we see stocks rally, we see, when we see real estate prices increase. Now, when we see all these assets rally, we actually get something called reflation, or the reflation trade. And that's just all of these assets just go up. I mean, you'll see small caps rally, mid caps rally, and that's just on the back of structurally higher inflation. And we even started to see glimpse of Powell saying that, at his testimonies today, the Fed kept saying our goal is 2%. He actually came out and had some hints that we're not trying to get exactly to 2%. It's around the 2% figure. So over the next couple of months, you're going to see his target of 2% move. Now let's switch gears and talk about the macro. Some very interesting stats I found right here. Now this essentially compares what the current economy looks like in comparison to the rest of history. And we could see here that we are in a regime most similar to periods of strong growth and most dissimilar to periods on the eve of the Great Recession. Our most similar month is June 1997 and other months in the period of strong economic growth in the late 90s. So this is referring to January 2004. Our least similar month is July 2008 with worsening financial conditions and the unwinding of the subprime mortgage crisis that led to the eventual collapse of Lehman Brothers. Long story short, looking at where earnings is, inflation, the jobs market, growth, credit spreads, all of that, we are more similar to periods here in the 90s than we were in 2008. Now let's actually talk about one aspect of growth, and we're going to talk about earnings, specifically company earnings, something we look at a lot on this channel because it is the major fundamental driver of flows. We do know that everything fits into one of three categories: the macro, fundamental, and the technical. We look at all three, and part of the fundamental picture, probably the biggest part of the fundamental picture, is corporate earnings. And we can see here that S&P 500 quarterly bottom up EPS estimates. So these are the actuals right here. These are the estimates. Q4 pretty much done. We got plus 9%. Q1 2024, we're looking at negative 1% earnings. I've seen some estimates saying 3%, possibly 4% now, but according to FactSet, we're doing negative 1%. Then we go on a gangbuster rally for the next 4 quarters from Q2 2024 to Q1 2025. Plus 7% growth, plus 14% growth, then plus 17 and then 14% again. And this is why stocks are rallying. Part of the reasoning is we are speculating and trying to price in some of this growth we're seeing. And we're also starting to price in a lot of growth from 2025 Q1, especially as we lead up into Q1 earnings 2024. We'll have to see how the strong growth translates into inflation, because something we're seeing is inflation forecasts are actually rising and well above the 2% target. Now the Fed want the inflation at 2%. Right now CPI forecasts for 2024 are sitting at about 2.7%. And if that's the case, it just means higher for longer. And that just means we're going to push rates further down into 2024, 2025. Now Powell did come out yesterday and say it's very likely we're going to cut in 2024. But for the most part, I think he is trying to appease Congress, people on Capitol Hill, the politicians, and if needed, he will push rate cuts out as far as they need. The Fed will do what's best to keep inflation under control. That being said, based on the data, based on what he said, we are expecting rate cuts in 2024. It depends what the inflation regime is going to look like throughout the rest of 2024. And right now, forecasts are sitting at 2.7%. Now, companies are set to make record profits in the next 12 to 18 months, like we just talked about. It might stoke inflation, but what exactly are companies going to do with that money? So we're going to talk about buybacks. This is one of the biggest reasons why stocks have absolutely rallied, especially in the last 10 years. It has to do with buybacks. Now, the Magnificent Seven, the level of net income versus the level of share repurchases by quarter. And you can see as net income has grown, so too has buybacks. And in this chart right here, we actually see annual net income and share repurchases. Now, we did go slightly down here in 2022, 2023, but with consensus earnings going gangbusters in the next 12 to 18 months, we could actually see an acceleration of share buybacks, especially from companies like Apple, Microsoft,
Microsoft, Google. Maybe we could even see share buybacks in Tesla potentially if earnings do get there, but I think Tesla's having a lot of cash flow issues. Looking at the S&P 500, buyback growth was actually negative. We saw huge amounts of buybacks here in 2021 when the Fed decided to inject $5 trillion worth of liquidity into the market. We can actually see that buybacks did trough. Now, that's not to say buybacks completely stopped. They just decreased 11%, then 21%, 23%, 22%, and so on. And we're looking now in the fourth quarter year 2023, buybacks are looking at 0%, and maybe, just maybe, we are done shrinking of buybacks and we will see buyback growth in the first quarter of 2024. Now, keeping up with the theme, guys. Now, buyback authorizations are tracking negative 27% year on year, as you can see right here. Now, this can change throughout 2024, but if we actually exclude CVX, which is Chevron, we actually see that buybacks are sort of tracking in line. And if we do get buyback increases, in the first quarter, second quarter, third quarter of this year, we could actually see buyback increases. But that being said, we have to see where it is right now. It is down negative 27 quarter over quarter, but in line, excluding a massive outlier. And here's the S&P 500 buyback decomposition by sector. You could see in 2019 versus 2023, so 5 years apart, the majority of buybacks came from infotech and financials, right? Buybacks have now broadened out across many industries. We could see comm services, a huge increase, 11% increase there. We could see consumer discretionary, energy as well, a 3x increase from 3% to 9% buybacks here in energy. Absolutely insane. Healthcare buybacks did actually decrease. All in all, we've seen a broadening out of total S&P 500 gross buybacks, and this is really, really good. This is actually what you want to see because now the average stock is starting to take part in buyback fever. Now, guys, looking at gamma, couple of things. The core gamma flip zone is still at 5,000, 510. We could see that core gamma resistance is at 5,200. It was at 5,100 at the start of the week. We've moved up the tape. We can also see a couple of things. A lot of positive gamma being built out right here below the 5,100. So a lot of people, selling calls, selling puts at these levels right here. At the same time, we also do see a bit of hedging activity below the 5,000 strike, a little bit concerning. Nonetheless, we are in a positive gamma environment. Buy the dip, look for 5,200. Now, in an environment where on the charts we look technically sound, fundamentally companies are doing really, really good in terms of earnings, profit margins, growth. The only thing that's going to disrupt this is a macro event. So if we do get pullbacks and the core gamma resistance stays at 5,200, you want to just look at those pullbacks as dip buying opportunities. If we do get a pullback and at the same time, the core gamma resistance moves down the tape and 5,100, 5,000, 5,900, that's when we can start looking at a deeper sell. Because at the end of the day, in a positive gamma environment, this strike right here, this call resistance strike, they call it a call wall, just acts as a magnet. The market gravitates to these levels in the S&P 500, especially the call resistance level. The market moves to the 5,200 area. So when you pull back, the call resistance hasn't moved at all. That's a dip buying opportunity because the market wants to take price here so dealers can hedge their books. When we're looking at the market that's technically and fundamentally sound, the only thing that's really going to disrupt this market right now is a macro event. Fed speak, really, really bad employment data, hot CPI, that is going to affect, interest rates, that is going to affect the market, that's going to cause a major pullback. But that pullback must coincide with gamma moving down the tape and potentially price going below the gamma flip zone. Other than that, it is always buy the dip in a positive gamma environment, okay, and hold. That's it. Now, let's talk seasonality. Very, very awesome chart I have here. This is the election year sitting president, right, running pattern. So 1949 to 2023, what can we expect? This is where we are right now. We're actually a little bit into March and a little bit higher, sort of like around here. But what we can normally expect is sort of like a flat right here to down period in the March month. And again, if we do just do this for March, don't be surprised. If we do go down, don't be surprised either. It's well within the normal seasonal trend. Now, looking at March in aggregate, what March actually normally does, not in an election year, not with a sitting president, is that we actually have very linear returns in March. We do have some pretty major dips right here and right here, but normally those dips don't go out and take the lows, and we actually make higher highs until we actually form some form of a double top here at the end of March. Now, this is the average performance from 1950 to 2023 and probably more indicative of the average year. Now, we're going to look at a bunch of seasonal patterns just to see where we are and what is to come. Now, this is the 10-year yield seasonality, and according to yields, we should actually see yields increase significantly here anywhere from about the 7th March to the 14th, and then have a ton of volatility leading to the end of March normally, where we do see a dip down into the April period. Now, looking at VIX seasonality, we could actually see quite a bit of volatility on the up and up into the 7th, 8th, and 9th of March, then a bit of a digestion period, and then we see volatility drop off as we go into OPEX and and the end of March. So if we do see a bit of volatility over the next couple of days, to be expected. US dollar seasonality, quite a lot of volatility here, but generally speaking, we go ahead, make higher highs, higher lows, and finish higher in the US dollar. Now, this is not very good for corporate earnings, and the Fed is working religiously to get the dollar as low as possible. That being said, according to seasonality, dollar does actually increase throughout the month of March. Now, looking at gold, gold is rallying, making all-time highs, not following seasonality at all. But typically, what we do see is a very steady decline here in gold, where we do form a double bottom towards the end of March and then have a steep rally into the April-May period. Looking at the AWCI, the All Country World Index, now this excludes US seasonality. What we actually find is very different to what happens to the S&P 500. We actually normally form a bottom here. We go ahead, make lows, form a bottom from the 7th to the 16th, and then we go on a blockbuster rally into the end of March, normally closing at highs for the month. And guys, looking at equity market breadth, this is the S&P 500, 400, and S&P 600, so small caps, large caps, mid caps, and we can see some very, very interesting things, guys. At the end of the day, this is new highs versus new lows, and what we can actually see is that equity market breadth is still very, very strong. Look at percentage of stocks at 1 month highs, 3 month highs, 6 month highs, 12 month highs, okay? 10% of stocks at 12 month highs, 52-week highs, and it has decreased recently, yes, but just 2 days ago, 21%, 3 days ago, 17%, okay? And then we actually compare that to stocks at 12 month lows, 6 month lows, 3 month lows. We can see very few stocks are at 52-week lows, and yeah, it's increased a little bit, but generally speaking, over a 2-week period, it has decreased. We actually see very similar strength here in mid caps, both in the new highs and the new lows, and small caps, it's looking a bit weaker. That being said, more stocks are reaching new highs than new lows, and overall over the last 2 weeks, 10 trading days, stocks are making new highs, fewer stocks are making new lows, and this is the hallmark of a great rally. If this does start to turn, that's when we could say, hey, things are changing. But as I see it right now, breadth is still healthy across the market. Now, something else I wanted to talk to you guys about is my portfolios, guys. These are 2 portfolios I gave 1st of January, and I said these were my top picks for growth and my top undervalued picks, and these are my top picks, right? So this portfolio is up 45% year to date, and we can see very linear returns. A little bit of volatility here and here. Other than that, we're trading at the highs, and it's completely outperformed the S&P 500. The S&P 500 is up like what, 8, maybe 7.5%, complete outperformance in every single regard. And the reason why is because these stocks are in here. You can see Nvidia, CrowdStrike, AMD, Celsius Holdings, all have double-digit returns except Google. Google's down about 2% for the year, the only underperformer in the portfolio, but I do have hope that this is going to produce double-digit returns for 2024. Now, my second portfolio, my undervalued portfolio, is up 14.2% for the year. Looking again, outperforming the SPY by 2x, the S&P 500. Complete outperformance, by the way. And this portfolio is more diverse. It's mostly just financials and technology, because I thought these are the sectors that are going to rally in 2023. And it has. It completely has. And you can see we have Accenture, ASML, American Express, Alibaba, Salesforce, Cisco, F5, Alphabet, Nvidia, PayPal, and then Charles Schwab. This is the worst performing stock. I think PayPal as well, along with Google. Other than that, we have outperformance in like ASML, ACN, American Express doing really, really well in financials. Same with F5, Nvidia too, Salesforce doing really, really well as well. A fantastic portfolio, more diversified. And I think that in the long term, this should do really, really well as well. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, guys. Like this video, leave a comment. It really helps me with the algorithm. Cheers.